Today, dangerous derivatives and why our banks are hiding them. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I'm joined again by Robbie Barwick from the CEC. Hello, Robbie.
Hello, Martin.
Thanks very much for spending some time with us once again. And we're going to look at a very important subject today, the question of derivatives. Now, this is something which has been bubbling around in the background for quite a few years, but given the current state of the financial system around the world and the size of the derivatives pot now, we think this is a very important subject.
Absolutely. The reason it's come up right now is I was participating in a meeting last week with John Adams and Philip Seuss from LF Economics, with some real experts on the Australian financial system and economy and our external debt, etc. But these experts were frank about the fact that despite everything they knew about the economy, they didn't have that good a sense of even what derivatives are, let alone where they fitted in with our current financial problems. And so it's worth people knowing that in depth because, I mean, it's the scariest thing in the financial system without a doubt.
And it's the least understood, and it's in a way super complicated, but it's also super easy once you get to understand how it really works. And so that's what we want to try and cover today. So this may be quite a long post, and it might be a bit complex in places, but I think it's worth hanging in there because it is really, really important for everybody to understand what derivatives are, how they work, and what the implicit risks are in the system, which frankly nobody in the official world really wants to come to terms with or even disclose.
No, absolutely. And just quickly before we begin, not to go off the subject, it is related, because people are used to you and I talking about GlassSteagall breaking up the banks and this inquiry. We've got a release on that on our website people can look at, Martin, but effectively Jane Hume, we call her the Senator for Bankers, has used her position as chair of the inquiry to kill the inquiry because she insisted on continuing it going while the election was on, and now we find out she's even contesting the election herself while she's pretending to chair our inquiry. However, don't take this as defeat because this is going to blow back on them. We have to make it blow back on them. What we're asking people to do, DFA viewers, if you made a submission, call up Jane Hume's office and the committee secretariat and ask them to publish your submission, because that's one of the things they haven't done. They admitted there's nearly 1,000 submissions. They've only put up 30. There was 30 last time we spoke. It's now 54. And ask them to do that, right? Because we're not going to let them get away with this. And it is related to this subject because, of course, the whole purpose of that bill is to excise this derivatives danger out of the normal banking system. I mean, that's a big part of it anyway.
Absolutely. So there's a deadly embrace between the derivatives sector and the broader banking system, and it's one of the biggest risks, and it's the unquantifiable nature of it, which is part of the issue. So absolutely right. Okay, well, I think a good place to start would be to talk a little bit about what a derivative actually is, because it gets very complicated quickly, but let me just sort of give you my perspective. So if you go back way back, right, derivatives started as essentially a way to help, for example, farmers in the US deal with the uncertainty about the price of the corn that they were growing. So what they could do was to agree a future price at a time in the future for the delivery of their corn, right, or pork bellies. So it gave them more certainty, and that's how derivatives started. Then what you could do is extend that slightly further and take an option on the price of the corn or the pork bellies, and the option was actually a very small fee to basically take a position. So you basically had a view as to where you thought a particular price was going to go in the future, and what you could then do is effectively secure a particular price, an option, a right to something in the future. So that's how it all started, and it started with physical commodities, but then it started to evolve into interest rates and currencies.
Yeah.
And again, originally it was to help companies essentially manage the future risk. So you could take a view on the exchange rate or on the interest rate, and you could take a particular option or one of the other derivative formulas to be able to secure a position to protect. Now, that was all well and good, but then some really smart people in the banking system started to realize that this opened the door to taking trading positions without actually needing to hold the physical positions, right? And so there was a massive acceleration and, frankly, a creation of many more different flavors of options and futures and swaps and other derivatives, a whole bunch of different things, options on options, to the point where now the bulk of the derivatives that are out there are not connected to any underlying asset or commodity. They are effectively positions on positions on positions. Right? And the bulk of the derivatives in the system now are held by financial institutions who are trading these positions and making a profit or a loss depending on how the movements of exchange rates and interest rates actually go. So we've moved away from something which was connected with physical commodities and actually had a reasonably good purpose to something which is now highly speculative, highly tradable, full of risk, but it's all about turning a profit for those big financial institutions. And, that in a 5-second story is how we got to where we got to.
Thanks, Professor. And the viewers should know. The viewers should know before we started, Martin informed me that he taught this back in the 80s. So if you want to know more, contact Martin. No, that's great. That is what it is. The two aspects of what you said I want to emphasize, though, is even from the very first futures, there's still a gamble involved, right? Because if the farmer, he locks in that price, if he's washed out by the weather or whatever, right, he makes a loss. So there's from even the normal hedging derivatives, the reason they call them hedging is specifically because there's an element of gambling involved. And then what you've gone on to elaborate is what we're always concerned about. Every evolution, every step is further and further and further away from the real economy, right? So they become completely disconnected to the underlying economy. However, they involve a lot of money, right? There's 1.2 quadrillion. I'll show some charts in a minute. That's one estimate of these things globally. They involve a lot of money, and that money is coming from somewhere, right? There is real money that gets drawn out of the real economy to feed this growing bubble, and that's a bubble full of gambling debts, essentially, right? That's what we're talking about, and that's why we see a disaster. It's provably been a disaster, and a bigger and bigger disaster is coming down the pipe.
And sorry, it's worth just saying that there, of course, are different ways to think about the quantum of the problem, right? So basically, there is the total face value of each derivative, right? Which is effectively the amount that people have taken a bet on, right? And that's the big number. And then, of course, many will claim, well, but that's an offsetting with another position that I've got over here. So, in fact, the net position is a lot lower, right? And then they also say, but of course, if it all worked out, then in fact the amount that I really am going to have to pay is much lower again.
Tiny, yeah.
Now, that is all well and good if interest rates and exchange rates stay roughly where they are. But if there is any significant movement up or down in the exchange rates or interest rates, then the exposure gets closer and closer towards the face value that we talked about, right? And so quite often you'll see that a lot of experts claim, no, the derivatives sector is really, really small. It's not a problem at all, right? But they're actually making a whole bunch of, maybe informed, maybe uninformed decisions about the situation. But the point is, if the financial system starts to actually get rocky and we see significant movements, then the value of the exposures goes up significantly. And because they're integrated into the broader banking system and into banks, it means that people's deposits and the rest of the banking system is absolutely caught right in the middle of potentially large losses from trading derivatives.
Well, this became an issue in 2008. Obviously, that was the big time, right? And the US banks and other banks around the world, their derivatives brought them down. Derivatives on their mortgage securitization, etc., brought them down. And of course, then they were threatening to take the derivatives, the deposits down with them, and governments had to step in and do the bailout. It was also the time, Martin, when because we've been monitoring the derivatives of Australian banks for a long time. It's the only time there was any attention in the mass media that we saw about what's going on in Australia's banks. I printed out this article from November 4, 2008, from the Sydney Morning Herald. Banks face challenge on billions of dollars of off-balance sheet exposure, and the figures at the time, total Australian banks derivatives were 13.8 trillion. That was the notional principal, or the face value, but APRA accepted a discounted figure of the credit equivalent, or whatever they call it, of 112 billion. So there's a huge difference between the 13.8 trillion and 112 billion. And APRA said, no, that's all that matters. But when APRA was questioned about, and it's all held off balance sheet, and I want to talk about that a bit more in a minute. When APRA was questioned about this, APRA said, we're not in the business of running banks. We're in the business of supervising them. So in other words, don't ask us what it is, really. Now, in the case of the one bank they highlighted in this at the time was Westpac, which the face value was 841.6 billion. One of their shareholders had started asking questions about this. Westpac had reduced that face value to 51 billion, right? So a little bit over 5% credit equivalent, and then using risk weighting, reduced that further to 27 billion. So all on its balance sheet, what was on its balance sheet was a 27 billion obligation that they claimed instead of the 841 billion. Anyway, the media said, they were saying, well, look what's happening in the States. Are those calculations right? There's this great quote here from Pauline Wallace. She was a partner at PricewaterhouseCoopers, an accounting expert. She was starting to question this. She says, I've always regarded off-balance sheet accounting as a bit of a magic trick. She said, magicians come to parties and they make things seem to disappear. The risk is somewhere, but you never knew where, right? And that's the main thing that we need people to start understanding about these things. There's an enormous amount of risk.
And Robbie, it's just to go on from there, one point, right? So here's the point. You can hold a whole lot of this risk off the balance sheet, right? Massive amounts, right? But because of the way that BAL works and the other capital calculations, the bit that actually appears on the balance sheet is just the tiniest tip of the iceberg, because they apply risk weights and, they offset and they basically mark to market and all those things, right? Okay. So that's the disconnect, right? So the bit you see in the bank's balance sheet is, 0.000 whatever it is of the real total exposures that they're actually dealing with. And yet the regulators around the world, including in Australia, seem to be relatively comfortable with that philosophy and approach. And yet we know that if the market moves a long way, then the amount of exposure that comes back onto the balance sheet is dramatically larger.
Let me make a plug here for Dr. Wilson's size submission to the banking inquiry. He's called it the farce of fake regulation, and it's on the inquiry website. But it's also on another website. I'll give you the link, and you can put it under the.
Yeah, we'll put it up. Yep.
But Dr. Sai worked at both APRA and ASIC. And I'll tell you what, when you have someone like him prepared to say what goes on inside, it's frightening. And I remember how blown away I was a few months ago when he told me that in the early 2000s, ASIC formed a panel to define derivatives. They worked on it, so they defined derivatives for the purpose of how they should choose to regulate them. They worked on it for a year and gave up, right? Did not come up with a definition of derivatives, and that's the regulator that's supposed to be making sure these things don't get out of control, right? So there's a real worry there. And then let's just look now at the cases of derivatives disasters. Before, I want to talk a bit about GlassSteagall in 1999, and then there's bill the following year in America to exempt derivatives from regulation called the Commodities Futures Modernisation Act. So let's look at the disasters before that. And when you have an appreciation of that, you see how dangerous these things can be, and the mistaken assumptions that the people who trade in them can have, right? And it also means that those bills in 1999 and 2000 in America, and what's happened in Australia since, is politically, it's unforgivable, right? But so you'd remember, you were there in the mid 80s when these things were started. So from about 86 onward, these over-the-counter derivatives between banks were starting to take off, as opposed to the exchange-traded derivatives that the farmers use, etc. There was in the early 90s, there was a series of massive disasters, though. So I'll just say some of them. So in 1994, Gibson greeting cards suffered a $20 million loss. And this is just a relatively, it's a mid-sized company in America, Ohio, I think, suffered a $20 million loss on derivatives sold to it by Bankers Trust. Also in 1994, Procter & Gamble, big company, suffered a $157 million loss, also on derivatives sold by Bankers Trust. Bankers Trust is now Deutsche Bank, right? The biggest derivatives basket case in the world. Also in 1994, and this is when people really started paying attention, was Orange County, California, right? $2 billion loss, 3,000 people unemployed. It's the richest county in America. That's why they had so much money to invest. But this guy, Robert Citron, was just a sucker for this Merrill Lynch trader, and massive losses on derivatives, $2 billion. And then people go, whoa, what's happening here? And then 1995, you had the first bank come down, Barings Bank in the UK. They tried to blame it on the lone trader in Singapore. They love doing that. $1.3 billion loss brought down, the oldest bank in the UK, I think it was at the time. But then the real big one was 1997, long-term capital management, right? Run by the smartest guys in the world, Nobel Prize winners, the Merton and Scholes, right? These guys who had all the calculations, as you know, on how to price options and all the geniuses, absolute geniuses, and they produced the biggest derivatives loss to date. $4.6 billion was the loss, but it wasn't just that hedge fund. There was something like 16 Wall Street banks exposed to it. They were all at risk. There was a massive crisis. How do you stop this blowing up the financial system, right? At the time, all on the back of this derivatives loss. And of course, what you can identify in that case with LTCM, it's a good case to see how the assumptions can be really mistaken, because as these losses mounted, more people started to analyse them and see the flaws in the thinking. One of the obvious flaws that expert statisticians will point out is they're trained to ignore the outliers as possibilities, right? So they make these assumptions, and extreme events or the black swan, that's not taken into account. Well, in the case of LTCM, that's what brought it down, because Russia defaulted on its bonds, massive spike in interest rates there, and all the bets that LTCM had made, and they made all these little tiny bets, gazillions of them, they all just cascaded into quickly mounting massive losses. And that was all before the repeal of the Glass-Steagall Act in 1999, all that had happened. And
Robbie, just to interrupt there, I'll just give a bit of my own history here, right? I was actually employed by National Westminster Bank in the UK to run their capital markets training unit, right? Because actually National Westminster Bank had a problem with Blue Arrow, which was another sort of similar thing, right? And they realised that none of their senior executives in the bank back then understood the derivatives market. Right. And so they decided to put all of their senior executives and the next level down, which were hundreds and hundreds of people globally, all through a training course to get everybody to understand what derivatives were, how they worked, and what the risks were, because it was like a completely closed book. They had no idea as to what was going on, and they had no understanding of the risks involved. So I was in the middle of that, right, which is why I was teaching all this stuff then. And it shows you the problem that there was then and still is today, that there aren't actually that many people who really have their head around this, right, and who really understand the way these things work and the risks in the system, right? And they can be bamboozled by mathematicians who claim to have the latest and greatest math calculations and, statistical models and all those sorts of things, which is why it's not a problem, et cetera, right? Until it is a problem, right? Because the problem is that all of these models and everything else is based on a certain set of assumptions about interest rates and exchange rates and what's going to do it, right? And if you then start running scenarios with changes in those interest rates, you can begin to see the true implications. And yet most of the models that people are running with don't do that. Because, as you say, they ignore the outliers. They basically just assume the sort of the normal course of business. And, of course, the trouble is that occasionally it's not normal course of business, right? Now, going back to your point, that was before Glass-Steagall was taken away in the US, so there was at least some disconnection between retail banking and, all this speculative stuff. But, of course, that changed, didn't it?
No, it did change, and just before we get into that, your story just then about National Westminster, you've had John Darlson on your show, former ANZ Bank Director. He had a similar experience. He was on the board, and at the same time, right, and he's looking at these derivatives and going, what are they? And he's asked people to explain them to him, and he admits, just as the minute he thought he had it, it went out of his head, etc. But and then there's a British economist, John Kay, who wrote a book, Other People's Money. He'd had the same experience at the same time with Halifax Bank of Scotland. He was on the board and he was going, what are you doing with these instruments? So, yes, we come to 1999, the repeal of Glass-Steagall. Now, if you look at the figures for over-the-counter derivatives in America before the repeal of Glass-Steagall, what you notice is that the biggest holders of derivatives were commercial banks, JP Morgan Chase, Citigroup, Citicorp, etc. Now, and the reason why is because in the 80s, in the era of deregulation, where philosophically the whole US government, they just wanted to deregulate everything. And as an aside, I'm reading William Black's book at the moment. The best way to rob a bank is to own one. And it's such a parallel for Australia today. Read that book if you get a chance. Anyway, in the 80s, here there were two things that the bank regulator, the Office of the Control of the Currency, was asked to rule on in relation to commercial banks' activities. One was securitization and one was derivatives, because the Glass-Steagall Act said commercial banks cannot deal in securities. They just can't. And here's two new forms of securities, and the pro-deregulation OCC, the regulator, said, yeah, both of those things are exempt from the Glass-Steagall Act. Now, so what happened by the time of 1999, Glass-Steagall had been watered down a lot. One of the effects of the repeal was the banks had already started this kind of gambling in derivatives, and essentially the deposits are there to collateralize that gambling. And the investment banks, the standalone investment banks like Lehman Brothers, like Goldman Sachs, they complained because they said, look, they went to the Treasury Secretary, the Goldman Sachs guy, Paulson, and they said, these big banks, they have an unfair advantage with their derivatives gambling because they've got deposits. You've got to let us increase our leverage, right? And so Paulson said, okay, right? And they went from 16 to 1 to all of them well over 30 to 1 in leverage. They were given permission to do that. And that's where the repeal of the Glass-Steagall Act was directly related to an absolute explosion, and I'll show charts on this in a minute, in derivatives gambling by all the banks, right? And later on, that's what came a cropper. The second event, though, was the next year. They passed a law called the Commodities Futures Modernisation Act. Both of these bills were written by Phil Gramm, the Texas Republican congressman. And that's significant because Phil Gramm's wife, Wendy Gramm, had been on the main derivatives regulator, the board, the Commodities Futures Trading Commission, in the early 90s. And as the head of that board, her last act in around 94 was to exempt derivatives from regulation then. She resigned, and Bill Clinton put her on, she resigned that position and she went and joined the board of Enron. And that moving from the derivatives regulator that she exempted from regulation to Enron was key. So 2000, her husband then passes a law to exempt all derivatives effectively from regulation. The next year, Enron blew up. in a derivatives fraud, right? And nearly blew the world up then in 2001. Very important. And so you've got these examples of, with Enron working your way back, of everything we've just said. Totally dangerous, but also an element of fraud involved. So I'd like to play. My first introduction to really getting a handle on derivatives, which I recommend for laymen, is this book. Keep my books behind me. Let me hold that up to the screen. This is an excellent book. Fiasco, Blood in the Water on Wall Street. So Frank Partnoy, the author, he was a Morgan Stanley derivatives salesman. And what he does here, he goes to great lengths to explain the various derivatives that they were trading in, formulating and trading in, right? And he has to sometimes simplify it because there's a lot of complex mathematics involved, as you know, etc. But he gives great examples. Some are called MX missiles and all sorts of things. You learn that Wall Street loves acronyms. You also learn that the way they would get their traders, sort of with a killer instinct, would take them out to paintball events and get them shooting each other, pretend to shoot each other and whatever, because they wanted that killer instinct. Frank Partnoy admits he quit the industry in the mid-90s because he says he was afraid of ending up in jail if it went on with what he saw. And he wrote this book about it. And it was ignored. The book was ignored. So this edition came out after 2008, and there's a foreword that basically says, "I told you so," right? It's very good. But Frank Partnoy, he's done there's a video you can see on YouTube, which we'll link to as well, but I want to play a little segment now. And what he's doing, he's going to show you a balance sheet and then tell you which bank is responsible for that balance sheet. And this is a balance sheet leading up to the 2008 crash for 4 years. And I'll let him do it.
Frank Partnoy, and this is a balance sheet. It is a real balance sheet of an actual company. Who is it? Well, let's look at it. 2006, 2007, 2008, 2009, we know what happened in those years. Company starts off strong, lots of assets, plenty of equity. 2007, tough year, still looks good, rock solid. 2008, very tough year, looks great. 2009, rockin' year in the markets. This is a stable company. Who is this? Do you know? I'm a professor, so I get to ask questions. Do you know who it is? Is this McDonald's? Is this a stable company that somehow survived the crisis? Do you know? Citigroup. This is the actual balance sheet of Citigroup. I want to talk about off-balance sheet transactions, what's not here. This is a company that went from a market capitalization of $250 billion to virtually zero. This is a company that went from making tens of billions of dollars a year to losing tens of billions of dollars a year. This is a company that required the government to ring-fence $306 billion of its liabilities in its own off-balance sheet transaction. And that's the picture of this company according to the balance sheet. What one word describes Citigroup's balance sheet? I'll use a different F word, fiction instead of fraud. The balance sheet is not a trivial document. It's a document that regulators rely on. It's a document that is the source of information for Tier 1 and Tier 2 capital. It's a document that regulations depend on. It's a document that investors look to. And it is a document that is a work of fiction. And until financial reform takes this into account, it won't work. And this is an issue that's not currently part of the debate. It's not on the table. It hasn't been discussed much. And I want to try to persuade you in just a few minutes that it needs to be on the table. And Lynn Turner and I have written a white paper. And you can look at all the materials in there. I want to try to make that case to you. This is not just about Citigroup, and it goes back a long time. It actually goes back to before Enron. There's a very good book called Infectious Greed, which a few of you may have written, that traces the history of some of this. Starting in the 1980s, Bankers Trust, Salomon Brothers, Enron, Bear Stearns, Lehman Brothers, Morgan Stanley. We know the story. Now the government of Greece and the United States has the largest off-balance sheet transactions of all. And it's not just about one bank, it's about all of our major financial institutions. It's also about a very large number of swaps and derivatives. So this number here, just to put in context, is roughly the notional value of derivatives. I want to just say one thing. There are a lot of media people here. The industry has been poo-pooing the use of this notional value, but notional value is a common sense value that we should use to describe the size of a market. If you have $100 worth of stock, you say, I have $100 worth of stock. You don't say on a risk-adjusted basis, based on VAR and some normal distribution, I have roughly $3 worth of stock. You say, I have $100 worth of stock. If you borrowed $100 and you made a loan and you put that on your balance sheet, you talk about a $100 transaction. If you do a swap, it's the equivalent of that. It has an asset leg and a liability leg. It's economically equivalent. It's a $100 transaction. This is the size of the derivatives market. This does not appear on balance sheets. Now, how big is $600 trillion? It's a lot of zeros. Let me give you a metaphor. Here's the Earth. The total size of global GDP is about $60 trillion. There's the Earth. Here are off-balance sheet transactions represented as swaps. Here's the universe that we don't know about of other off-balance sheet transactions, some of which we write about that are not captured in the $600 trillion worth of swaps. Fiction.
Now, the balance sheet, as you saw, is of Citibank. The bank, so had a perfect balance sheet, absolutely perfect balance sheet, but this is the bank that was the recipient of the biggest bailout in the 2008 crisis. Because as Partnoy said, as you saw, it's a fraud, right? This off-balance sheet, Citibank proves that this off-balance sheet accounting is fraudulent. And therefore, you got to appreciate that when you see what we know about Australian bank derivatives. So should we look at those now, Martin?
Yeah, I think we should bring it back to Australia because, of course, the global derivatives pie is very big. But worryingly, the Australian segment of the pie is also extremely exposed, and we've got a small number of large players who are right in the middle of it.
Yes. So I've got for those who've hung in this long, appreciate that. We've got pictures now, so that's gonna make it easier. So we've got a slideshow here that you'll all get to see. But just before I give you the first one, I just want to make this point. So the CEC, we're a political party, and our interest, as Martin and I have discussed, is a functioning economy. And over the era of neoliberalism, the concern was the whole economy, not just derivatives, got further and further away from a real economy and more financialized, you can say, right? So we have an association with the late American economist Lyndon LaRouche, and in 1993, his organization produced this pamphlet, it was called Tax Derivatives Speculation, Pop the Financial Bubble, Rebuild the World Economy. And the reason I'm highlighting this is because the same year, the Financial Review in Australia announced it wanted to do a feature on these new products, these new financial products called derivatives, which no one knew anything about. And they asked for submissions. So we made a submission, and we basically submitted this pamphlet of how we viewed derivatives. And the Financial Review, when it produced this feature on derivatives, it opened by quoting our pamphlet. And the specific thing it quoted was this. Let us imagine visitors from a solar system in a distant galaxy coming to Earth on a trade mission, presumably, and ask oneself, would they invest in the planet Earth at this time after seeing the flurry of the market in derivatives? I propose they would pack up and leave immediately, writing Earth off as an investment for perhaps at least a century to come. And this is just, these things were already unreal, but at the time of writing that, there was about $30 trillion worth of them in the world, right? And they just quickly got more and more out of control. So let's have a look at these charts now. This is one that we produced in 2004. So that's why some of these are black and white, and I apologise for that. I've scanned them from old publications that we did. So what you see there is just the really rapid growth in derivatives, and that's in trillions of dollars, right?
So this is US trillions of dollars, the global picture, and it's the notional value. So this is the gross value of all the derivatives. Yep.
The gross value.
Yep.
And it only gets worse. So go to the next one. So that is the up-to-date figure. You can see that this now starts roughly. Think of it as starting around the time of the repeal of GlassSteagall, right? And you can see straight away this uptick in the growth rate in these things. I imposed the GDP line there just by way of contrast. And if anything, that there's different estimates of what world GDP is. That's one of the higher ones. So, it could even be less than that.
Sorry, the OTC derivatives definitions that the BIS is using for this chart, they've actually skinned it back, right? Yes. So this is probably quite a conservative picture of the true total exposure.
Yes, there's a mathematician in the United Kingdom who's a hedge fund manager and quite an expert in this. He insists that the actual figure from his informed calculations, I'm just looking for his name, he insists it's at least $1.2 quadrillion, right? 1,200 trillion. So effectively, basically double what they've got here.
But the point is, Robbie, if it's 600 trillion or 1 X quadrillion, it's still way, way, way bigger than the real economy.
No, for sure, for sure. So what's ever going to pay the bill on these things, right? All right. So those are the overall. Let's look at some specifics now. So this is I did this back in 1997, and all you had to do was read through the annual reports of the major banks, and there was never a chart of it. What you found is in a footnote. They would say, this is what our total notional principal derivatives are. So let me point out in this particular, so we've contrasted the derivatives to the assets of the bank and the equity. This is all in the billions, hundreds of billions compared to the assets and the equity. Nothing was over $1 trillion yet, right? But this is 1997, and of course ANZ is miles in front of, say, the CBA. That was the year CBA's privatisation was finalised, and you'll see in the next charts the difference that made to CBA. So then if you jump to the next one, so that previous one was the first derivatives chart that the CEC did to say, look at the state of derivatives in Australia banks. Now look at that difference. So we might have, I couldn't find if we'd produced any in the interim, but in 2004 we produced this one. Again, the information freely available in the footnotes of the annual reports. But look at the difference with NAB. Right, so now it's not just broken $1 trillion, it's nearly $2 trillion. You saw my email, Martin. What I found interesting is in that 7-year period, ANZ had barely budged.
Yep.
I asked John Dalson, could this be the John Dalson effect? Because here's a board member asking questions. What are these things? Please explain them to me. And did that have an influence in the bank saying, we should be cautious on these instruments? Because if it doesn't, I don't know what it takes to make them cautious, because there were derivatives explosions going off all over the world in this period, right? They must have. There's a good reason to be cautious.
Yeah,
and he certainly wasn't.
And it's worth saying that NAB, of course, around that time and a bit before, expanded globally. So they basically reached out to Asia, to the UK, and to the US. So essentially, they were trying at that stage to become a true global player. And so perhaps not surprising to see that their derivatives book exploded.
Well, that's right. Exploding in two ways, because you may also remember it was also around that time that NAB suffered what's probably regarded as Australia's only big derivatives loss. It was something like a $400 million, they declared $400 million loss on their derivatives. Yep. My understanding is the NAB executive, I can't remember her name at the moment. Someone informed me she's a mentor of Kelly O'Dwyer. Someone else pointed out that our friend Jane Hume was with NAB at this time. So anyway, you got a whole bunch of these NAB guys in Parliament now as well. It's proved to be a pretty disastrous bank for its customers in many respects, but this is you can see where its priorities lie in this chart. And then the others are looking a bit more conservative by contrast, but that doesn't last. So have a look at this next one. So we produced this one in time for because of the 2008 crisis, right? So we've jumped forward another 4 years. You see, NAB has it was nearly 2 trillion before. Now it's well over 3 trillion. ANZ is jumping back up. Commonwealth Bank's a bit more cautious, And I'm singling that out because I want you to see, especially what happens to Commonwealth Bank in the next period. This is what the Australian bank derivatives are at the time of a global derivatives meltdown. That's what's going on when they've declared these figures, right? Now, if you go back to that earlier chart from the Bank for International Settlements, what you see in that chart is at this time, that's when derivatives growth by the BIS figures stopped. There was a plateau, there was a fall and a general plateau. It's only really gone above that once since by the BIS figures. So globally, the incredible post-repeal of Glass-Steagall growth that was seen came to an end in derivatives, if you just go by the BIS figures. That's the snapshot of Australia's banks. But what happened in Australia after this period? Well, so this is the next year. The reason we did this, and if I just show you the contrast, there's not a lot of difference yet, but there's NAB's gone down a bit. The purpose of doing this particular chart was we wanted to contrast the derivatives with deposits, and the point of that was to show that if these became a problem, the government here would also have to bail out the banks just as the US government had done, right? For the same reason. There's no way that the deposits would be able to pay the derivatives losses on derivatives exposure that's this big. So that's the purpose of doing that.
And just to be fair, Robbie, just those are the gross exposures. So essentially, there will be some netting off, and there will be some cancelling out. But nevertheless, the ratio comparing deposits to the derivatives just shows how big the risks are. And as we say, it's unknowable. The amount of risk is actually unknowable because it depends on where interest rates and exchange rates go.
Yep. So now, what are the executives of Australia's banks thinking? They've had a crisis. Derivatives were at the heart of it. What do? The rest of the world's cooling off a bit. What happens in Australia? Well, now you start to see what really does happen in Australia. This chart shows is the following year, massive jumps by all banks in their derivatives exposure. Massive jumps. The biggest one is the Commonwealth Bank. It's gone from it's now at 2.8 trillion, whereas it was 1.5 trillion in the 2009 chart. It's now 2.8, massive jump. You think, what the hell's going on at this time? Now, and before you might have some views on that, Martin, but the next year shows same thing, even more. But this year, this is the last year the Commonwealth Bank disclosed its actual derivatives. They started removing that figure from their annual report, the notional principal, and insisting that's not a relevant figure anymore. Right? I called them up because we were producing this chart every year. I called them up. Got put through to. I remember I was put through to some boardroom where a couple of guys had me on a speakerphone. And I'm going, what gives? Why aren't you producing that figure anymore? And they're saying, no, it's not relevant. It's not relevant. I said, it's not relevant. Where just a few years ago, the global financial system melted down because of these things, and you're saying a true picture of your derivatives is not relevant. They go, oh no. Those were dangerous credit derivatives. We don't trade in those kind of derivatives. Ours are, this is a quote, plain vanilla derivatives, right? Plain vanilla. And I said, well, if they're plain vanilla derivatives, why are they growing so fast? What are you doing that justifies this incredible growth in your plain, quote unquote, plain vanilla derivatives that suddenly you have to stop disclosing them? And of course, they didn't want to answer that question, right? The call ended soon after that. But if you move now to the next one, just to emphasize the growth rate. So this is all four right side by side, and the grey bars are our guesstimates. Now we have no idea, right? That's why there's big question marks on it. But we're making those guesstimates on the basis that the Reserve Bank every year does produce gross figures for all the banks collectively, not broken down by banks. You don't know, but their growth was also the collective growth in this time, and I'll show a chart on that in a minute, was also going off the charts, right? Yeah. So you see the red line is 2008, the global financial crisis, and what you see is the incredible growth after that, in the case of all the banks. And then by the time we produced this report in 2016, this chart, NAB had also stopped disclosing its derivatives, right? So a few years after CBA did, NAB did. Now, then we produced this our iconic poster. What lurks below? Because it's just getting people to think about how the banking system is actually working here, right? This is, if they're not even, so they're already off balance sheet. Therefore, you're not allowed to see what you don't know what the nature of the actual derivatives trades are, right? That's not known. The regulators don't know. The auditors certainly don't bother looking at it, right? So no one knows. And then, in the case of CBA, at the time of this, we won't even tell you anymore, right? Mm-hmm. So real worries there. And we're trying to make these points about it all the time. People need to look at this. What's going on here? And of course, we produced a poster like that, circulated through Parliament. That's the sort of thing you do to get politicians' attentions, Martin.
Well, it's simple.
It is simple. All right, and then I just wanted. We made this one, and there's something very obviously lacking in this one, but we'll talk about that in a minute. I just want to make the point about it. So, we're looking at the growth of the profits of the banks. And, of course, that's the other thing that was going on. They're just record-breaking profits. Again, post-GFC, all the banks in the world are basket cases except these great Australian banks, record-breaking profits. So we said, well, there's the profits on the left, the difference between 2008 and 2014, incredible growth in profits. What's happening in the real economy that's justifying those profits, right? Well, GDP hasn't grown very much. Population hasn't grown very much. Employed persons hasn't grown very much. Weekly earnings haven't grown very much. Derivatives have grown a lot. And then this is where I'd like your view, though, because to me, what's obviously missing from this chart is bank lending on mortgages.
Correct. Yeah, that's the other biggie. Yeah.
And the derivatives are related to that lending. That's what people have to understand about if you had to identify the number one source of the growth in the bank's derivatives, it's their lending on mortgages that they're securitizing and gambling on.
Yep. Robbie, it's worth saying that ANZ and NAB reported their results this week, right? And because of the slowdown in the mortgage lending book, all of them had profit problems with that part of the book. But guess which part of the business actually overperformed? It was the commercial institutional banking. In other words, where all the derivatives live. And in fact, I think one of them reported a 33% increase in profitability from that segment of their business. So you can see that they are now extremely reliant on the institutional banking to try and prop the whole bank up.
Yep. And dare I say it, I have no basis of knowing this about Australia's banks, but I remember when I read Partnoy's book, the number one quote that caught my eye was, derivatives can be used to hide losses and make losses appear to be profits for a time. And that's a part of this. We can talk about the derivatives on this, take it at face value and go, well, there's dangers just if they're used normally, but there's a hell of a lot of fraud that gets hidden away in these things as well. And, you've got to shake your head when it comes to the Australian banking system, to be honest. So I don't know. We don't have access to it. It's why we're calling for a full audit of the banks by the Auditor General. It needs the Auditor General with what's happening in the banks needs to get into this. But there you go. What you just said is further example of the need of that. This is what you're dealing with in Australia, and then just two charts left. So here's the situation now. ANZ has also suddenly stopped disclosing its derivatives, right? And the only one the thing to point out, what's the difference between Westpac and the other three? I mean, Westpac is, in all other respects, a similar business model, etc. I think it's the second largest mortgage lender after CBA. But you have to notice that its growth was more conservative. Its derivatives growth was more conservative than the other banks. So the three tearaway banks that just went the fastest into derivatives, they've now all stopped disclosing their full face value, right, of what's off their balance sheet. And to me, that is incredibly suspicious, right? Why do they feel the need to do that? Because I can tell you, before 2012, Martin, you've got 15 years where religiously every year this figure was in their annual reports.
Yep.
Right?
Absolutely.
Now it's not. And so the final one, which viewers might have seen, you used this in one of your reports last year on derivatives, is this one. This is the aggregate. These are the figures recorded by the Reserve Bank of Australia. And one of the things you notice there is, so the obvious thing, they were growing fast enough before the global financial crisis, slight downtick, but then incredible growth after the global financial crisis. In the last few years, you see these massive spikes up. There's that one around 2015. There was like a $6 trillion increase in bank derivatives in one quarter. $6 trillion, the fastest growth rate in Australian bank derivatives we've actually tracked. And dare I say it, that related to this period where bank interest-only lending just was soaring off the chart. All the bad practices of banks that we've been identifying in their normal banking was all going crazy as well, right? That now people that left the time bombs in the mortgage sector that we're all waiting to see explode, and so the derivatives will go up, come down a bit, and then go up. They broke over $40 trillion last year. They're back down to 38 trillion, but you can see that's just extreme fluctuations at the top at the moment. The direction they're going is obvious. So this is the part of the financial system people need to pay attention to. Right, this is where when we express concern about bail-in, for instance, the logic of bail-in is how do you stop one or more banks setting off global contagion and destabilising the global financial system? Where you've got to inoculate those banks, you bail in their customers so it doesn't do that. And the number one concern the architects of bail-in have is if banks such as Australia's banks default on their obligations to their derivatives counterparties, right? Because they would have a lot of derivatives counterparties around the world, and massive problems in Australia's banks, if that affects their derivatives trades and what they are obliged to pay to their counterparties, can set off that kind of scenario where Lehman Brothers in 2008, it defaulted on derivatives obligations that then set off a much bigger problem in AIG. Right, that's the logic here, and you see where it's a disaster waiting to happen in our view.
And it's worth saying, Robbie, that the chances are that some of those derivatives contracts are between fellow Australian banks. Yeah. Right. So effectively, it could well be that Bank A in Australia has a connection with Bank B around derivative contracts, but they'll also have a whole spider web of contracts and relationships globally with the other banks around the world.
Well, Just on that, before you go on, because you'd have a better view than me. It occurred to me with the growth we've seen, though, that it would be somewhat limited how much the Australian banking system itself, if it was just between the big four banks, could absorb this growth. And that alone tells me there must be a lot of trading with counterparties around the world.
Yeah, I was going to say exactly the same thing. So there will be some locally, but the bulk of it will be internationally, and it will be in the context of the offshore funding of the banks, as well as them taking positions vis-a-vis other institutions around the world. So the point is, it's like the banking system is like a whole series of threads woven together. It's a rug, right? But if a bit of a fraying happens over here, it might be in the US, it might be in China, it might be in Europe. The chances are that thread will go rip right the way across and will hit the financial system globally, which is why, of course, the regulators are absolutely panicky about trying to keep a cap on the financial system and not let any part of it fall apart, right? Yep. Because they know that if one part goes, the whole thing is likely to follow, which is why we're at such a high risk point in the evolution of the financial system. So we have to try and find a way of unpicking all of that, right? And so the whole thing about GlassSteagall is it tries to make some separation between these high-risk speculative activities and the meat and potato banking, which is effectively the stuff that we need and want, because the trouble is that the derivatives, if they go wrong, could well swamp the rest of the assets of the banks in Australia or elsewhere, and that could trigger, a critical issue locally as well as a significant event internationally. So we are at a very precarious state, and this derivative story is right at the heart of it.
Yep, and that's right. GlassSteagall is by any measure, the first thing to do here. And the other thing that, as I mentioned earlier, is we're calling for an audit of the big four banks, right? If you're objective about the Australian financial system at the moment, aka not Peter Switzer or Christopher Joy, and look at the property problems, the property price falls, and how much the banks are exposed to that, you're going, well, we better see what's really in their books, based on the US experience, the Irish experience, etc. So we need the big four global regulators are not good enough, right? They've been complicit in bank problems all around the world. We need the Auditor General to step in and do an audit that actually goes into the assumptions behind these derivatives as well, right? And so the government can actually start seeing what's there. Now, and then what GlassSteagall does is you can carve out the commercial bank, and then you still got to deal with this derivatives problem, but the investment banking side that you force off, the derivatives that it can't handle itself have to be unwound somehow, right? Some have to be cancelled. A lot of unwinding has to be done. Now, we have the pleasure of knowing the former Deputy Director of the Ministry of Finance of Japan. We brought him out to Australia in 2014, and we got to have a meeting in Joe Hockey's office. Joe Hockey was the treasurer. He wasn't there, but we met with his chief economist, who was an obnoxious character, who now works at the Banking Association, Tony Pearson. When this subject came up, Tony Pearson said to us, this is what he said. He said, you ever bought an airline ticket? Yeah. Well, you bought a derivative then. And Wacker Williams was present in this meeting, and Wacker Williams, to cut the tension, made a joke. He said, oh, well, maybe if you bought a Qantas one. Right? But, that was the mentality. Don't worry about that. This is all just normal stuff. It's no different than buying an airline ticket. No, sorry, it's very different to buying an airline ticket, right? Many, many, many more steps removed from that slight gamble you make when you buy an airline ticket. And he's the guy in charge of the treasurer who's in charge of the regulators at the time, right? That's the mentality you're dealing with. Our friend, though, Daisuke, as the head of the Ministry of Finance in Japan in the 90s, he had to resolve a Japanese banking crisis in 1998 that was caused by derivatives sold to it by American companies. And the way they did it was they had to take these banks over on a weekend and get in there and cancel and unwind a lot of their derivatives. And their concern at that time was making sure that Japanese crisis did not trigger a global crisis through the counterparties. That's why they did it. Now, at the time, though, Martin, Japan had GlassSteagall, because it had had it ever since America took Japan over after World War II. America made sure they had GlassSteagall as well. That provided a framework which helped him do his job, right? And just as a quick aside, he likes telling this story. He only had the authority to deal with foreign institutions that had a license to operate in Japan, and a bunch of them didn't. One of those that didn't, this Daisuke Kodagawa, he would call them in and give them a warning, saying, we know what you're up to, we're watching you. And so the main one of those companies that had the worst practices packed up and left and moved to London and set up office there instead, and that was AIG Financial Products. And if you know that is the institution that brought down the global financial system in 2008. If they had had a license in Japan in 1998, the Japanese authorities may have been able to take action against them that averted what happened 10 years later, an irony of history. So this guy's an expert, and he says that's what you got to do. You got to step in there and unwind and cancel a lot of these things. He's also more recently, when he was asked about how you would deal with Deutsche Bank, because Deutsche Bank, for those who have followed this, is the biggest derivatives basket case in the world. It's got all that's left of bankers' trust bad bets, etc. And he said the same thing. The German government has to take it over and step in and cancel and unwind these derivatives, right? You cannot leave this up to free market to sort of work it out. Otherwise, you're just waiting for a bomb to go off. And that's what we're saying has to happen in Australia. Audit the banks, find out what the real problem is, and separate them and get this out. So you have a firewall between that problem in the financial and the real financial system. But with the derivatives, there still needs to be attention given to them so that you can reduce the problem massively.
Yeah, and I'd add just one more point, Robbie. This may be a bit contentious, but I believe that something else that should be brought in is a financial transaction tax, right?
Yep.
Because if you actually had a small tax on every one of these, the profitability would just completely disappear,
Upright.
and it would actually stop dead in its tracks. So one of the things that I've held for some time is that a financial transaction tax, one, would generate a bit of income which would help the government coffers, but two, it would actually also help to solve this. So that's something else which I would advocate.
And that's what we said to the Australian government in 1993.
Yep.
Get tax these things, because we did a calculation a few years ago. We calculated the turnover in all financial markets in Australia, and if you did a $1 in 1,000, 0.1% tax, which a normal shareholder in a bank could easily afford, if every 6 months if they buy new shares, they can handle $1 in 1,000. That would raise $130 billion, because the total turnover in this, exchange rates, etc., $130 trillion. But of course, it would only raise it once, because the very act of taxing it would reduce so much the completely useless speculation here that contributes nothing to the financial system, nothing to the economy. But it's a real danger when it's left unchecked.
Yeah, no, that's right. And then the final point I'd like to make is, people might be saying, well, what can I do, right? Now, my thought is, if you are a shareholder of one of our big banks, right, why don't you write to them and ask them why they are not disclosing the amount of derivatives they actually have, and ask what that number is.
That's right. Go to the annual general meeting and ask it from the floor if you got
correct. Exactly. Because it seems to me strange, peculiar, and downright deceptive not to be disclosing this gross amount.
Well, that man, from the reason the Sydney Morning Herald did this article in 2008, not just because the financial system had got out of whack globally and people weren't worrying, it's because the William Pender, the mayor of Robe in South Australia, he made an issue of it with Westpac. He said, I want to know, and that forced the media, got the media's attention and forced Westpac to try and answer some questions here. Do that, write to them, go to the annual general meetings and demand it.
It's pretty important. Robbie, I think we've hit the hour pretty much, so that's probably our longest post ever, but I think it is a really important subject, right? Not just for the local banks here, but globally. But specifically, we do have issues in Australia. We know we have issues. And in the context of that banking separation, inquiry, which is, petering out, and, this is another reason why that's a critical thing to happen.
Yep. Absolutely, and we'll keep pushing. We'll keep pushing GlassSteagall. We'll keep pushing bank separation. But this is another reason. If you're wondering why we push it so hard, and all the viewers can help in the process. Keep supporting the fight for those things. Keep on to members of parliament. They know nothing on this stuff. Just keep pushing all the time, and the message will get through.
And please share this post as widely as you can, because the more people who understand what's really going on, the more chance we have of affecting positive change.
Absolutely.
Robbie, thank you very much for your time today. Appreciate it.
Thank you, Martin.
So there you have it, a very important discussion. And whilst it was a long post and a bit complicated, I think there are some really important messages. The bottom line is that derivatives are a high-risk activity in the banking system, and more controls need to be brought in place to bring it back into line. I'm Martin North from Digital Finance Analytics. Many thanks for watching. I'll see you again next time.